Welcome to AudioNote, the home of smart listeners and busy readers. We break down famous books into clear steps so you can learn, act, and win. Join our community, build your reading habit, and stack insights daily. Subscribe now. Your next breakthrough is a play buffle away. Let's start with today's summary.
Imagine a business partner who shows up every day, offering to buy your shares or sell you his, sometimes at prices that make sense, often at prices that don't. Graham calls him Mr. Market. Your edge isn't predicting his moods, it's disciplining your own. This book is not about quick wins, it's about principles that keep you rational when others aren't. Invest with analysis, preserve principle, demand an adequate return, and let the market serve you, never instruct you. Chapter 1. Investment versus Speculation. Results to be expected by the intelligent investor. Graham begins with a definition. An investment operation is one which, after thorough analysis, promises safety of principle and an adequate return. Anything else is speculation. This boundary line is the foundation for every decision that follows. If you can't justify a purchase by facts about a business, its assets, earnings power, and prospects, you're not investing. He sets realistic expectations. Markets fluctuate, sometimes wildly, and even sound investments can deliver poor short-term results. The intelligent investor accepts this and builds a process that works despite it. That process rests on discipline, not forecasts. Graham distinguishes two archetypes. The defensive investor prioritizes safety and freedom from effort. The enterprising investor accepts more work and more judgment for potentially higher returns. Both can succeed if they obey rules suitable to their temperament and time. A central warning. Performance chasing is self-defeating. The past leaders of any period are often tomorrow's laggards. The goal is not to beat the market each year, but to follow a policy you can stick with through bull and bear phases. Finally, Graham frames analysis as protection against yourself. Facts and valuation provide guardrails, preventing emotional buying at highs and panic selling at lows. Start with definition, continue with discipline, and measure success by adherence to sound policy, not by temporary applause from Mr. Market. Chapter 2. The Investor and Inflation. Inflation corrodes purchasing power and complicates long-term planning. Graham rejects simplistic answers. Neither stocks nor bonds are guaranteed hedges. Fixed income assets feel inflation immediately through lost real yield. Common stocks represent real businesses that can raise prices, but their market valuations can still compress, leaving investors disappointed. He encourages realism. Expect that the dollar or any currency will buy less over time. Design policy to survive this drift. For the defensive investor, that suggests a balanced allocation between high-grade bonds and equities, adjusted within sensible limits when markets are extreme. The aim is durability, not precision hedging. Graham cautions against overpaying for supposed inflation-proof assets. When investors crowd into a theme, they push prices beyond intrinsic value, reducing future returns and magnifying downside. Better to insist on a margin between price and appraised worth, regardless of the theme's popularity. He also notes that corporate earnings reported in nominal terms can flatter reality. Inflation can lift revenues while leaving real economic gain modest after costs and capital needs. The intelligent investor scrutinizes quality of earnings and the capital required to sustain them. Bottom line, build an allocation that acknowledges inflation but refuses to gamble on any single antidote. Protect purchasing power through valuation discipline, diversification, and a policy you can hold through shifting macro winds. Chapter 3. A Century of Stock Market History. The level of stock prices in early history for Graham is a teacher of humility. Markets cycle through exuberance and despair. Both pass. Studying long spans reveals that prices swing far above and below reasonable estimates of value. The lesson is not to forecast turning points, but to prepare for them. Graham reviews a century of returns to show that equities have delivered meaningful long-term gains, but only for those who endured declines without abandoning their plan. Periods of inflated valuations breed lower subsequent returns. Conversely, when valuations compress, prospective returns improve. Valuation matters, even if timing does not. He issues two cautions. First, do not universalize a recent trend. A powerful bull market can seduce investors into extrapolating indefinitely. A crushing bear can make equities look permanently broken. Both are illusions created by recency bias. Second, understand the baseline of yields available on bonds when judging relative attractiveness of stocks. For policy, Graham recommends anchoring decisions to long-term averages and ranges rather than headlines. If the market's level is far above historical norms, lean modestly cautious. If far below, lean modestly bold, always within predetermined asset mix boundaries that fit your temperament. History's verdict is steady. The market offers opportunity to the patient and punishment to the impulsive. Build a plan that assumes full cycles, not straight lines. Chapter 4: General Portfolio Policy. The Defensive Investor. The defensive investor wants results without constant analysis. Graham prescribes a simple, robust policy. Keep a balanced mix between high-grade bonds and common stocks, often near 50-50, adjusted only when valuations are clearly extreme, but never outside a 25%-75% band on either side. This rule dampens emotion by pre-committing to ranges. For bonds, quality is non-negotiable. Favor government or top-tier corporate issues. Avoid stretching for yield. Safety of principle is the purpose of the fixed income side, not excitement. For stocks, emphasize broad diversification, large and conservatively financed companies, and reasonable valuations. The defensive investor is not trying to discover hidden gems, they're trying to avoid obvious mistakes. Dollar cost averaging into equities and forces discipline. By investing fixed sums at regular intervals, you buy more shares when prices are low and fewer when they are high. This method subdues market timing impulses and compounds patience. Graham also stresses behavior. Tolerate underperformance in exuberant periods. Your restraint then is the price of resilience later. The defensive investor's superiority, when it appears, usually emerges after booms turn to busts. In short, set a sensible allocation, buy quality, diversify, add steadily, and ignore the noise. Your greatest edge is a plan you actually follow. Chapter 5. The Defensive Investor and Common Stocks. Graham proposes concrete tests for stock selection suitable for defensive investors. The company should be of adequate size, financially strong, modest debt relative to assets, and have a long record of profitability and dividends, often 10 to 20 years. Earnings should be reasonably stable across cycles. Avoid firms with flashy growth, but fragile balance sheets. Valuation discipline is essential. Pay moderate multiples of earnings and book value rather than gross stock premiums. Graham's spirit is clear, even if numbers evolve over eras. Prefer companies where current price already embeds caution, not perfection. The investor trades excitement for reliability. He emphasizes diversification across industries to mute idiosyncratic shocks. Defensive portfolios should not rely on forecasts of any one sector or manager's special genius. They should survive error. Dividends matter not as lottery tickets, but as evidence of underlying earning power and management's regard for shareholders. Importantly, Graham warns against new issues and popular favorites, areas where enthusiasm tends to overwhelm appraisal. The defensive investor's watchwords are quality, consistency, and reasonableness of price. These criteria may feel dull during speculative frenzies, but they protect against the permanent losses that often follow. The chapters promise: if you insist on strength and pay a fair or better price, you tilt odds towards satisfactory. If unspectacular, long-term results, exactly what a defensive policy seeks. Chapter 6: The Enterprising Investor, Negative Approach. Enterprising investors accept extra work. Graham begins not with what to buy, but what to avoid. Shun new issues, IPOs, priced for perfection. Promoters sell when the market is eager, not when value is obvious. Be wary of high-yield bonds of dubious quality. The yield premium often hides unacceptable risk. Avoid complicated accounting stories and companies that must perpetually raise capital to survive. Treat glamour growth stocks with skepticism when their prices imply heroic assumptions. Even good businesses can be bad investments if bought too dear. Graham cautions against market forecasting and short-term trading as primary strategies. They seduce with action but rarely deliver results commensurate with the effort and cost. The enterprising edge comes from judicious selection and patient ownership, not from guessing the next move. He also criticizes reliance on inside information or hot tips, hazardous to judgment and often unlawful. Better edges are legal, repeatable, and rooted in public facts that others neglect. This negative approach clears the field. By refusing the common traps over promotion, leverage masquerading as yield, narrative-driven valuations, the enterprising investor preserves capital and attention for genuine bargains. Discipline begins with saying no more often than yes. Chapter 7: The Enterprising Investor. Positive Approach. Having fenced out hazards, Graham outlines proactive methods. Look for bargain issues, securities selling below conservatively appraised value. Classic categories include net-nets, stocks priced below net current assets, undervalued but sound industrials, special situations workouts, mergers, liquidations, spin-offs, and relatively unpopular large companies temporarily out of favor. The method is evidence-driven. Analyze assets, earnings power, and catalysts where applicable. Demand a margin of safety, a pricing cushion that protects against analytical error and adverse developments. This cushion converts uncertainty from enemy to ally. Patience is a tool. Bargains often require time for recognition. The enterprising investor accepts dull periods, confident that value and price tend to converge. Diversification still matters, though portfolios may be more concentrated than defensive ones, provided each position offers its own margin. Graham stresses temperament. The work invites contrarian stances, which are emotionally taxing. You must tolerate being early and looking wrong for stretches. Record-keeping, post-mortems, and a clear checklist help sustain consistency. Success here is not guaranteed, and certainly not easy. But with sound appraisal, insistence on price discipline, and steady behavior, the enterprising investor can reasonably expect superior long-term results earned, not guessed. Chapter 8: The Investor and Market Fluctuations. This is the behavioral heart of the book. Graham introduces Mr. Market, your manic depressive partner, who quotes you a price daily. You are free to ignore him. Use his moods. Do not mirror them. Buy when he offers a bargain, sell when he bids irrationally high, and otherwise let him talk to himself. Volatility is not risk. Permanent loss is. Price declines by themselves are not failures if the business value is intact and the position was bought with a cushion. Conversely, rising prices do not validate a poor purchase at an inflated valuation. Separate process from outcome. Graham encourages an owner's mindset. Appraise the business. Treat quotes as opportunities to adjust, not commands to react. Dollar cost averaging, rebalancing within preset ranges, and insisting on margins of safety are practical ways to harness fluctuations constructively. He also warns against margin leverage, which converts routine volatility into potential ruin. The intelligent investor plans for bad weather before it arrives. The chapter's enduring image is liberating. The market exists to serve you. When it's helpful, engage. When it's unhelpful, ignore. Your advantage is detachment anchored in valuation. Chapter 9: Investing in investment funds. Mutual funds and similar vehicles offer convenience, diversification, and professional management, but not magic. Graham challenges investors to scrutinize costs and to distrust performance chasing. Funds that top the charts in one period often regress. Fees, turnover, and taxes compound quietly against you. He recommends judging funds by sensible criteria: long-term consistency, reasonable expenses, a clearly stated policy, and the manager's willingness to avoid hot period speculation. For most defensive investors, a simple, broadly diversified, low-cost approach will outrun most active alternatives after costs. Graham also notes structural incentives. Managers may hug benchmarks to avoid career risk, or, conversely, reach for return to attract assets. Neither motive necessarily aligns with the shareholder's best interest. Transparency and policy discipline matter more than glossy brochures. He is not absolutist. Skilled managers exist, but identifying them in advance is difficult, and paying high fees for the hope of skill is hazardous. The intelligent investor resists marketing narratives, demands evidence, and defaults to simplicity unless a compelling, verifiable edge appears. The guiding question: does this fund help you implement a policy you can hold? If not, avoid outsourcing conviction to product shelves. Chapter 10. The Investor and His Advisors. Advisors can provide structure, education, and behavioral guardrails. Graham's test is alignment. Seek professionals who emphasize policy, cost control, and valuation discipline, not forecasts and fads. They should discourage impulsive moves and explain decisions in plain language rooted in analysis. He urges skepticism toward fee models that encourage excessive trading or asset gathering. Understand exactly how your advisor is compensated and whether that structure prioritizes your long-term results. A modest, transparent fee for truly helpful guidance can be worthwhile. A rich fee for promises about the future is not. Graham proposes practical roles for advisors, helping define an appropriate defensive or enterprising posture, designing an allocation with rebalancing bands, teaching clients to read reports, and performing conservative appraisals of securities when warranted. Good advisors temper emotions. They are partners in process, not prophets of performance. Finally, he reminds investors that responsibility cannot be fully delegated. Even with an advisor, you must understand the core principles: margin of safety, quality, diversification, and price discipline, so you can judge advice intelligently. Competence plus character is the standard. If either is missing, keep looking. Chapter 11. Security Analysis for the Lay Investor. General Approach. Graham's invitation to the non-professional is simple. You don't need to be an expert analyst to practice sound analysis. What you need is a framework. Insist on facts, compare price with value, and demand a margin of safety. The lay investor's task is not to predict the future with precision, but to avoid clear errors and overpayment. Security analysis, in this spirit, is a process of elimination as much as selection. He suggests beginning with 4 anchors. First, examine the financial strength, balance sheet quality, debt levels, working capital, and interest coverage. Second, assess earnings power across cycles, not just a banner year. Third, review the dividend record and policies as evidence of consistent profitability and shareholder regard. Fourth, apply reasonable valuation tests, moderate multiples of earnings and book value, avoiding glamour premiums that assume heroic growth. Graham warns against false precision. Elaborate models can seduce you into believing you know more than you do. Many uncertainties, competition, regulation, technology, resist quantification. Therefore, the antidote is pricing cushion and quality. If a business must execute perfectly for you to break even, you paid too much. If middling results still yield a satisfactory outcome, you likely purchased well. He also emphasizes comparative analysis. Place a candidate next to peers. How does its profitability, leverage, and valuation stack up? Differences should be grounded in real advantages, not promotional narrative. When in doubt, downgrade enthusiasm, upgrade skepticism, and record your reasoning so you can later evaluate judgment versus luck. Above all, Graham restores analysis to its practical core. Protect principle, seek adequate return, and let facts outrank forecasts. The lay investor can do this. You don't need prophetic vision, just intellectual honesty, a checklist, and the humility to say pass when the numbers don't justify the story. Chapter 12. Things to consider about per-share earnings. Earnings per share look objective, but Graham demonstrates how accounting and context can distort them. Start by asking, are reported earnings representative of the earning power of the business? One-time gains, aggressive revenue recognition, inventory methods, and depreciation assumptions can all inflate the headline number. The intelligent investor adjusts, normalizes, and sometimes ignores EPS when it is clearly untrustworthy. He stresses the cyclical lens. For many companies, especially industrials, peak profits arrive near cycle tops and vanish in recessions. Judging a company by peak EPS invites overpayment and disappointment. Graham recommends looking at multi-year averages, such as 7 or 10 years, to smooth the cycle. Averages cool the heat of narratives and reintroduce reality. Stock-based compensation, write-ups, and tax quirks can further detach reported EPS from economic truth. Graham's message is not cynicism but curation. Dissect the components. What portion of earnings is recurring? How much is dependent on favorable prices or transient cost savings? What capital expenditure is required to sustain these earnings? True profitability should account for the capital needed to maintain the asset base. Finally, EPS must be connected to price. Even high-quality, well-measured earnings can be a poor foundation if the market asks an excessive multiple. Conversely, modest but steady earnings bought at a humble price can outperform glamour profits purchased at 48. EPS is a tool, not a talisman. Use it to inform appraisal, not to justify excitement. The corrective habit Graham leaves you with is disciplined skepticism. Standardize, average, adjust for quality, and always translate earnings into what matters most, intrinsic value per share compared to today's quotation. Chapter 13. A comparison of 4 listed companies. To show analysis in action, Graham compares several companies across quality, stability, and valuation. The casework highlights a durable lesson. A good business isn't automatically a good investment if the price assumes perfection, and an ordinary business can be a respectable investment if the price already bakes in caution. The spread between what you pay and what you get rules outcomes. He lines up the companies on key axes: balance sheet strength, debt versus equity, working capital, 10-year earnings records, consistency versus volatility, dividend histories, and price ratios, PE, price to book. He demonstrates how a flashy growth record can mask fragility, thin margins, heavy leverage, or sensitivity to a single product or cycle. Conversely, a dull stalwart with conservative financing and unbroken dividends may offer superior resilience and more predictable compounding. Graham also explores market reputation. Some companies are beloved, drawing premium multiples that compress future returns. Others are neglected, trading at discounts that quietly cushion risk. He urges you to ask, what must go right for this valuation to hold? If expectations are extreme, small disappointments can cause large price damage. The chapter culminates in a pragmatic takeaway. Rank candidates, don't romance them. If 2 companies are roughly similar in quality, choose the one at the lower price relative to assets and earnings. If one is clearly higher quality, pay a moderate premium, never an extravagant one, and if none meet your tests, hold cash and wait. Patience is part of analysis. Opportunity comes not on schedule but in cycles. Through side-by-side comparison, Graham equips you to replace stories with standards, enthusiasm with evidence, and impulse with interval, the pause in which good decisions live. Chapter 14. Stock selection. For the defensive investor, Graham translates principle into a checklist, built for investors who want results without constant vigilance. His criteria include 1. Adequate company size to avoid frailty. 2. Strong financial condition, current ratio comfort, modest long-term debt. 3. Earnings stability over a decade. 4. Dividend record for many years. 5. Earnings growth over the long run, not spectacular, just steady. And 6. Moderate valuation limits on PE and price to book that anchor expectations. The defensive investor's edge is quality price. Buy a diversified basket, often 10 to 30 names of large conservatively financed companies at reasonable multiples. Avoid glamour issues, story stocks and IPOs. Prefer firms with simple businesses you can understand from public reports. This is not a search for the next big thing. It's a policy of avoiding obvious mistakes. Graham also endorses index-like solutions when they are low cost and broad, acknowledging that many defensive investors will outperform most active managers through cost control and consistency alone. But for those picking stocks, he insists on a repeatable screen. Statistical strength first, narrative second. Rebalancing plays a quiet role. When equities run far ahead, trim back toward your target mix. When they sink, add. This rule forces you to do emotionally hard things. Sell strength, buy weakness, without agonizing over forecasts. The defensive investor trusts rules over impulses. In essence, Chapter 14 offers a peace treaty. You can own common stocks, withstand cycles, and sleep at night if you insist on durability, diversification, and don't overpay. Boredom, in this approach, is not a bug, it's the moat. Chapter 15. Stock selection for the enterprising investor. For investors willing to do more work, Graham outlines fertile hunting grounds. Categories include 1. Relatively unpopular large companies trading at conservative multiples. 2. Bargain issues, selling below appraised asset value, including net-nets in rare times. 3. Special situations, workouts, mergers, spin-offs, liquidations, where outcomes are event-driven. And 4. Secondary companies with clean balance sheets and low prices relative to earnings and assets. The enterprising investor applies deeper appraisal, scrutinize inventory and receivables for quality, test depreciation realism, gauge competitive position, and check whether management allocates capital sensibly. The key is margin of safety in the numbers. Catalysts help, but are not mandatory if the discount is substantial and the business is solvent. Graham warns against two temptations: reaching for glamour growth at any price, and treating turnarounds as sure things. Both can work but often disappoint. The sturdier edge is buying what's sound but shunned, where expectations are already low. Diversify across several such bets, expect some to fail and others to more than compensate. Patience and temperament are indispensable. You may look wrong for months while the market chases fashion. Keep records, review thesis drift, and sell when price converges on value or when facts break the thesis. The enterprising path is craft, not adrenaline, a practiced habit of saying no often and yes only when arithmetic and prudence agree. Chapter 16. Convertible issues and warrants. Hybrids, convertible bonds, preferreds, and warrants offer upside participation with downside features. Graham approaches them with caution. Convertibles can look safe because they are bonds, yet their market pricing often embeds a hidden growth premium for the underlying stock. In booms, that premium swells. In downturns, it can evaporate, leaving holders with a bond that no longer offers adequate yield for its risk. He asks you to separate the bond value as a pure fixed income instrument from the conversion option. What interest rate would make the bond attractive without the conversion privilege? If the standalone bond looks weak, you are effectively paying equity-like prices through the back door. Similarly, warrants, rights to buy shares at set prices, are leveraged bets whose value depends on volatility and future enthusiasm. They can compound gains, but also magnify overpayment. Graham does not banish hybrids. Used prudently, especially when the bond floor is strong and the conversion terms are conservative. They can serve as enterprising positions. But for the defensive investor, most convertibles and warrants are unnecessary complexity that adds behavioral risk. The safer route is to buy solid bonds for income and solid equities for ownership, rather than blending the two into an instrument that can mislead. His filter is consistent. If a hybrid's math, yields, coverage, conversion terms gives you a cushion, and you understand precisely what you own, proceed carefully. If the appeal rests on hope, promotion, or the magic word convertible, pass. Chapter 17. 4 extremely instructive case histories. Graham turns teacher with case histories that dramatize his rules. Each story shows how valuation, financial strength, and investor behavior shape outcomes. In one, a reputable company admired for growth becomes a poor investment because investors bid it to untenable multiples. When growth normalizes, the stock compresses brutally. Lesson: great company nail great stock at any price. Another case explores the neglected bargain, a company with pedestrian reputation but sturdy balance sheet and low valuation. Patient holders realize solid gains when either results improve modestly or the market simply re-rates the shares to fair value. Lesson: modest expectations, low price can be powerful. A third illustrates accounting surprises. Reported profits flatter reality until inventory adjustments and write-downs force a reckoning. Investors who relied on headline EPS suffer. Those who inspected footnotes and margins were forewarned. Lesson: read the statements, not just the summary. The final case shows how leverage turns a manageable setback into permanent loss. A cyclical downturn meets heavy debt, and equity is wiped out. Lesson: the balance sheet is not a backdrop. It's the stage on which risk performs. Graham's moral is steady. Systems beat stories. If you buy with a margin of safety, prefer strength to stretch, and doubt enthusiasm that demands perfection, you avoid most disasters, and you position yourself to benefit when sanity returns. Chapter 18. A comparison of 8 pairs of companies. Here Graham pairs companies with similar lines of business but different market reputations. One is fashionable, trading at premium multiples. The other is overlooked, selling cheaply despite comparable or even superior fundamentals. By stepping through 8 such duos, he demonstrates how expectations dominate pricing and how disciplined investors can profit by siding with the unfashionable. The exercise isn't about being contrarian for sport. It's about measuring quality versus price, where the favorite commands twice the PE with only marginally better margins or growth prospects. The sober choice is the cheaper peer, especially if its balance sheet is stronger or its dividend record is longer. When expectations are embedded in price, the higher bar belongs to the glamour issue. Any stumble is punished. Graham also shows that the market periodically reverses its preferences. Yesterday's darling becomes today's disappointment. Yesterday's wallflower enjoys mean reversion. Long-term investors who keep standards, adequate size, strong finances, steady earnings, dividends, and moderate price often ride these shifts without drama. The chapter trains your eye to see substitution. You don't need exposure to the hottest name to benefit from an industry's economics. Choose the sound counterpart at a humbler valuation. Keep notes on why one peer earns a premium and reassess periodically. If the reasons fade while the premium persists, rotate quietly. Graham's paired comparisons are a clinic in relative value. Don't just ask, is this good? Ask, what else of similar quality costs less? That question alone has saved many investors from paying prestige prices for average outcomes. Chapter 19. Shareholders and management's dividend policy. Dividends reveal character of cash flows and of management. Graham values a long, continuous dividend record as evidence of consistent earning power and a shareholder-friendly culture. While retaining earnings for productive reinvestment is sensible, a chronic refusal to share profits can signal empire building or an unwillingness to face capital allocation discipline. He encourages investors to examine payout ratios over cycles and the correspondence between reported earnings, free cash flow, and dividends. If dividends are repeatedly funded by debt or asset sales, something is amiss. Conversely, modest, reliable payouts align the interests of owners and managers, supplying tangible returns independent of market moods. Graham is skeptical of dividend fashion. In some eras, companies tout reinvestment as inherently superior. In others, buybacks eclipse dividends as the preferred distribution. He advises judging by math and motive. Are reinvested dollars earning attractive returns? Are buybacks executed at sensible prices rather than at cycle peaks? A board that raises dividends prudently and repurchases shares opportunistically when the stock is cheap demonstrates stewardship. For the investor, dividends also support behavioral resilience. Receiving cash while prices swoon can steady nerves and reduce the temptation to sell at lows. Still, he warns against chasing yield that springs from weak credit or shrinking businesses. Quality first, yield second. Ultimately, dividend policy is a window into governance. Trust the boards that explain decisions plainly, keep promises, and treat shareholders as partners, not as an audience. Chapter 20, Margin of Safety, as the central concept of investment. Graham closes with the book's heartbeat, margin of safety. Because the future is uncertain and analysis is fallible, investors must demand a cushion, a price sufficiently below conservatively appraised value to absorb errors, bad luck, and cycles. This is not pessimism, it's engineering. Bridges are built to carry loads far greater than expected. Portfolios should be too. Margin of safety appears in many forms. In valuation, buying at discounts to earnings power and asset value. In balance sheets, favoring strong finances that withstand storms. In diversification, spreading bets so that one mistake doesn't sink the ship. In behavior, adopting policies like rebalancing and dollar-cost averaging that protect you from your own moods. Graham insists that investors abandon the illusion of precision. Intrinsic value is a range, not a point. If your estimate must be exactly right for the purchase to work, you lack a margin of safety. Better to accept rough appraisal and a deep discount than to worship exactness with no cushion. Time, too, is a safety device. A long horizon lets temporary price errors self-correct. He contrasts investing with speculation. One last time. Speculation seeks profit from price movement. Investment seeks profit from business value, with margin of safety as its shield. When the market is euphoric, margin shrinks and risk rises. When the market is despondent, margin expands and opportunity appears, provided you kept cash, courage, and standards. The final counsel is ethical as much as technical. Be intellectually honest, patient, and disciplined. If you make margin of safety your rule, your default question before every purchase, you won't be right every time. You will, however, be durably right enough, and in the market, that is the only victory that compounds. The market will always tempt you with shortcuts, fads, and forecasts, but Graham's voice cuts through the noise. Investing is not about brilliance, it's about character. With discipline, patience, and margin of safety as your compass, you turn volatility into opportunity and confusion into clarity. So the question is, will you let Mr. Market dictate your future, or will you master your own temperament and let principles guide you? If this summary helped you see investing differently, don't stop here. Hit subscribe, share this audiobook with a friend, and join us as we bring you more timeless wisdom from the greatest financial minds in history. Your journey as an intelligent investor has just begun. Are you ready to take the next step?